Always great to have you with us, Megan. So of the numbers that we got out this morning, what really struck you as most important?
Look, I think the numbers that we got out tell broadly the same story, which is fairly encouraging. It's that the economy is slowing down marginally. So we're taking some of the heat off of the economy and hopefully, therefore, off of inflation. You saw that in the income and spending data most of all. And that's the story that is consistent with what Chair Powell had been saying yesterday at the Brookings Institution, which you guys covered. So there is some evidence now that what the Fed is trying to do will happen. The big question is whether the Fed can continue to do this without pitching the U.S. into a recession or not. And the Fed is hopeful that maybe they can avoid a recession. I'm much less hopeful on that, actually. I think we probably will have a recession, but it's going to take a while because there's so much cash in the economy, both among households in aggregate and also among corporates.
So pursue that, if you would, Megan. I know you had a column in the Financial Times just today on that. You sort of talked about waiting for Godot. Everybody keeps talking about this recession. It seems to keep putting off and on. Are you confident we will have a recession? And if so, when, given the rate of drawdown of the savings?
Yeah, look, this has to be the most anticipated recession in U.S. history. It feels that way. At least everyone is forecasting one, including myself. So I think we are going to have a recession, though. If you look at the U.S. economy in a global perspective, actually, it kind of looks like the cleanest shirt in the dirty laundry basket. Insofar as things aren't great, we're slowing down significantly, but we're actually looking better than most other developed markets. That's partly because Europe is disproportionately hit by the war in Ukraine, but it's also because of the stimulus measures after the pandemic, which left Americans and companies in the U.S. with this huge cash cushion. If you look at all the indicators, though, it looks like that cash cushion is wearing out pretty rapidly now. So, for example, on the consumer side, U.S. households have increased the amount of credit card debt that they have pretty significantly. The jump was 15% in the third quarter. It's the biggest jump we've seen in about 20 years, suggesting that some households really are squeezed and are sticking purchases on credit cards instead of using the cash that they don't have anymore. If you look at loan defaults among corporates as well, that's ticking up. It's also ticking up among consumers. And so it suggests we've been in a good position because of this big cash buffer, but actually it's whittling down. And if companies start running out of cash, their profits start falling as borrowing costs are increasing, they're not going to keep as many people on their payroll rather. And so then consumers will stop spending. It tends to be more whether they have job prospects than whether they have cash in the bank that affects consumption in the U.S. and across the developed world. And so that's when we'll get a recession. I think it will probably happen around the middle of next year.
So Megan, is that unemployment yet another Godot that we're waiting for? Because you heard Jay Powell yesterday, and then although the JOLTS numbers came down a little bit, they have a long way to go to get down to even the record of the JOLTS numbers pre-pandemic. So at this point, we don't see a lot of erosion in the employment situation, do we?
No, that's right. The labor market remains really strong, and I think that's why consumers are still spending so robustly. We see that in the retail sales data. We saw it in the Black Friday data, and that's because most people still have jobs. It's when people start being laid off that I think everybody really retrenches, either because they've been laid off or they're worried about being laid off. And so far, unemployment has ticked up from a post-pandemic low of 3.5% to 3.7%. That's still incredibly low by historical standards. And so there is a ways to go. The Fed is really hoping, actually, that we'll just whittle down those job openings rather than seeing a significant uptick in inflation. Larry Summers and Olivier Blanchard have been out there looking at the data and arguing that's a really nice theory, but it's just literally never happened. And I'm a little more sympathetic to the latter argument just because there is no historical precedent for it. That being said, we've just been through a massive pandemic, so a lot of new things are happening in the economy.
Megan, as you know so well, we have another data point coming up tomorrow with the jobs numbers in the United States. Do you want to get in the office pool about what you're expecting? I think the consensus is something like 200,000 new jobs.
Yeah, I think that's about right. So I think, new job creation should be slowing. 200,000 is still incredibly strong, though. What's just as important, I think, is the wage data. So if we see average hourly earnings continue to decelerate, that's good news for inflation. It suggests this, there is really no wage price spiral happening. That should take some heat off of inflation, which I think we've seen the peak of already. I think that's behind us. And so that's the data point I'll be looking for in the jobs data tomorrow, more so than the headline figure.
And what does this all say to the Fed? We heard from Jay Powell yesterday. The market certainly reacted very strongly. I'm not sure, looking back on exactly what they were reacting to, but what does it say to the Fed? We have some more data points before the December meeting.
Yeah, I would agree with you. I think the market reaction yesterday was pretty overdone. There was really nothing new in what Jay Powell said. Someone else had already said pretty much all of it. But, I think that the investors have been pushing the Fed to pivot all along since inflation really took off. I think this means that the Fed is slowing the economy down. That's exactly what it's trying to do, and that should be bringing inflation down. Inflation is well above the Fed's target of around 2% on average over a period of time. So there's a ways to go. So I think the Fed will slow down its pace of rate hikes, but I think it will continue hiking rates into next year. I actually think rates will end up getting up just above 5%, which is a little bit below consensus.
Megan, we always hear about the long and variable lags of monetary policy, and that's in terms of the strength of the economy, as I understand it. Is there another long and variable lag, which is the effect on debt? That is to say, we've loaded a lot of debt, both public and private debt, up with the interest rates being very, very low. It may take some time before the practical effects of a significant increase in interest rates are felt by people who have to repay that debt, whether they're individuals or corporations.
Yeah, so overall global debt to GDP has ticked down a little bit since the height a few quarters ago. It's now just under 350% of GDP. That is well above where it was before the global financial crisis. And it's hard to imagine that we're going to have a global rate hiking cycle without seeing a whole bunch of defaults. The only question is, who's defaulting and how systemic is that? And then is there a policy response to that? I think we've seen some hint of what's to come in the UK, just over a month ago when gilt yields spiked and you had an LDI blow up in the pension sector. The Bank of England stepped in to paper that over with liquidity operations. And that's the good news. Our central banks actually have the tools to step in. The Fed buys corporate debt now, for example. They're unlikely to want to buy junk corporate debt, but they do have the tools to step in and buy corporate debt. And so I think we will see swift severe market dislocations that central banks have to step in and paper over with liquidity operations that will be called QE. And the big worry is that QE is thought to be inflationary. And so if central banks keep stepping in with QE, investors might think, well, that's inflationary, that's undermining what they're doing. And then they'll end up having to hike even higher to lean against inflation and push us all into a deeper recession. That's one of the biggest risks, in my view, for 2023.